Welcome, options traders, and happy Friday to everyone. Well, I've got another great question for the group. What's the probability an option loses 50%? And of course, we're talking about 50% of its initial value. Now, I'm not necessarily picking on 50% for any reason. We could ask that for lots of different percentages. But I'm choosing just to keep the video short, 50%, because I hear a lot of option traders say that they want to set stop losses at a 50% loss, as if that somehow is going to make them a long-term winner if they can get out without losing everything. Now, again, another question is, well, why 50%? Why not 45 or 57? I don't really know where that number came from. I don't think there's any mathematical reason, but it's just something that gets handed down from trader to trader, that you have to set this 50% stop. So let's find out, if you do that, what's the probability that you're going to get stopped out? And so before we go on further with the video, I want you to think about it. What does your intuition tell you? Keeping in mind that there's probably a 50% chance for the stock to rise or for it to fall. The stock paths basically follow a bell curve. What does your intuition tell you should be the probability? And before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So the problem that I've described here, the option falling to a certain level, is what's called a barrier problem. There's a certain level, a line in the sand, and we're just trying to say what's the probability that the stock price touches or crosses this barrier. So for instance, let's say that the stock is trading for 100 and we want to know the probability that the stock hits 95 at some point in its life. Well, in that example, that 95 figure right there is called the barrier. And these are important for a lot of different things in options. There are actually exotic options called barrier options. You can't buy them on the CBOE, but you'd have to go to a broker like a Goldman Sachs and they can customize these. They're called exotic options. It's actually one of many classes of exotics. But with the barriers, there are knockouts and knock-ins. There's different flavors of them, but they all fall under this umbrella of barriers. And so that's what a barrier is. It's just a line in the sand. We're trying to say what's the probability that we touch it or that we just fall through it. Now, interestingly, there is no formula. At least there's no what's called a closed form. You can't just plug in numbers and get an answer. And part of the reason is that we have lots of moving parts. We have the stock price that's moving, and in most cases, especially for short-term options, that's going to be the main driver. But we definitely have time passing, and we also have volatility that might be changing. And all of these can change those probabilities. So do we want to assume that only the stock price moves and we hold time fixed, let's say at 30 days? Or do we want to say that the stock price can move and time can move? See, it starts to become a very sticky problem. So what we usually do is say, let's just look at it with the time being constant. Let's just check it for the stock price moving and know that that's kind of the minimum of what the answer actually is. So for example, let's say our stock is trading for 100. We have a strike at 100. We've got an at-the-money option. We have 30 days till expiration. Risk-free interest rate is 0%. Volatility is 20%. So the question is, what's the probability the option loses 50% of its value at some time during its life? Now notice that's different. A lot of times we want to know the probability that it's, let's say, out of the money at expiration. And that's a little different problem, because here, just because it might touch that barrier and be an out of the money if that were expiration, nothing says it can't reverse and get back out of it. So there are definitely different problems. So conceptually, what we're doing here, we've seen this before in previous videos. If we were to do, let's say, hundreds of different stocks or thousands, we're going to start them all at $100 and turn them loose for 252 trading days. Now for this video, I just made it for 250 days to make it a nice round number, but roughly the number of trading days in a year. And of course, if we just let volatility do its work, we're not accounting for news or anything like that, we can see that we don't always get the same path. On average, we should go sideways. If the stock starts at 100, whether it's 30 days later, 6 months later, a year later, your best guess is 100, today's stock price. But we can see that we can drift from it, and in some cases quite a bit. So what the barrier problems are saying, all right, well, given this, what if we had our barrier, let's say, at 80? We're just saying, what's the probability that we touch this barrier? Now notice again, that's different because we could just do simulations and say how many closed below it over here at expiration. But that's not really what we're asking with a barrier problem or a touch problem. Because, for instance, you might say, well, like this orange line up here, just to make it easy to see, yeah, it closed way up, but that doesn't mean it didn't come down and touch the black line at some time. So just because it didn't close below the black line doesn't mean it didn't touch it. And again, if you were using this as a stop order, you're going to get out. That's your definition. I paid $3 for the option. When it gets to $1.50, I want out. And so you're definitely going to be out. And see, that's key. You're not allowing it to maybe reverse. And part of the problem is, I think, is psychological, that people say, geez, I've already lost 50%, and I just know, got such bad luck, it's obviously going down, I just don't want to lose it all, let me get out. But that's definitely not true. That is not mathematically true. There is a mirror image, and we'll see why in just a moment, that it could also end up on the other side of the barrier. So how would we go about figuring this out? Well, remember, we've seen this in previous videos as well. You can see some symmetry here. There's a certain probability for the stock to get way up here and to get way down here. Most of the time it will be here in the middle. And if we were to tally up all of the terminal stock prices at the end of a year and graph them, guess what we'd get? We'd get our friend, the bell curve. So you can see that most of the time we will stay within the bell curve. In this example, I made the volatility 20%, so 3 standard deviations up at the end of a year is 60 points. And you can see that right there at 160, not too often that we got above that. Now, just like this orange line up here, remember that doesn't mean that you cannot get above 3 standard deviations. If we did millions and millions of simulations, you'd get some that are easily 3 and 4 and 5 standard deviations out. They would just be incredibly rare. So to the downside, if we have 100 minus 60, that would put us at 40. And you can see that that's kind of where that bell curve is touching there. In this case, we didn't even get close to it there. But that would be the range that we would at least expect most of the time. So once we know that we have a bell curve here, we can go back to our bell curve probabilities. So we know that within 1 standard deviation, the blue right here, 68% of your data will fall. Within 2 standard deviations, blue plus gray, we have 95% of the data. And then essentially all, about 99.7% of your data fall within 3 standard deviations. But as I said before, notice that is not 100%. That is not saying that that's the limit. These little standard deviations just keep going forever. But for the most part, they're not even worth talking about because it might take a billion years to get out here to 6 or 7 standard deviations. So that's the basic idea of what we're going to do. Let's now jump over to an Excel spreadsheet and find out how we would do the calculations. All right, so now we're into our Excel spreadsheet, and the first thing we need to do is to figure out our barrier. Remember, we had a 30-day option, $100 stock, $100 strike, and we wanted to know at what stock price will cause that option's price to lose 50%. So to find that stock price, I'm going to go to a pricing model, and I'm going to use the one from bar chart over here. So we've got the stock at 100, strike at 100, 30 days to expiration, risk-free interest rate at 0, volatility 20%. And the model is telling us that the theoretical price is $229. I'm just going to round that to $230. Now, a little side note, remember what that's telling you is that if you paid $230 or if you sold it for $230 over and over and over, not counting commissions, you would just break even. So we definitely have a hill to climb because of this extrinsic value. That's what the fair value means. And it's another reason why you have to be careful about using stop orders. So now the question is, what stock price will make that, again, let's call it half price or $1.15? So one way we can do it is to just start poking around here. $1.40 is too high. We come up here to 97, get $1.06, and we keep playing around here. Let's try 97.3. That's close enough. So let's just call it 97.3. So remember, we are holding time constant. We're just assuming at this volatility for really the first day, what's the probability that we hit here at 97.3. So the actual probability is going to be higher just because time is going to be moving and possibly volatility. But this will at least be a place to start. So let's use our barrier as 97.3. And now, if we take 97.3 divided by 100, we have to take what's called the natural log, which is just saying e raised to some number is going to take us from 100 down to 97.3. You can think of it as roughly as saying that 97.3 is about 2.7% below 100. That's basically what that's telling you. So let's hold that, kind of store that over here. Volatility is 20%, days to expiration 30. But remember, we can't use volatility of 20 because that's the annual volatility. We're only talking about a 30-day option. So we've covered this in previous videos. We need to scale this. And remember that option prices are proportional to the square root of time. So we have to take 30 divided by 360, or you could do 365, and the square root of that, and then multiply it by your volatility. And we're going to get 0.0573, roughly 0.06. So if you think back to the earlier example when I said over the course of a year, volatility was 20%, we had $20 plus and minus 20 bucks. We could go up a total of 60, 3 standard deviations, or fall down 60 points down to 40. But that's assuming a full year. That's very unlikely to happen over 30 days. It's exactly the same math, but now we're going to be using roughly 6%. So at the end of 30 days, we would expect 68% of the time, the middle of that bell curve, this stock is going to be plus or minus $6. 2 standard deviations would be plus or minus $12, and so on. So we're just using exactly the same math. Now what we're going to do is to find out what's called the z-value. If you've had statistics, it's just that little number under the bell curve. So if you recall, under a bell curve, 0 standard deviations is the center. This would be plus 1 standard deviation. This would be minus 1 standard deviation. Here's minus 2, minus 3, and so on. Well, those aren't the only standard deviations. We could have a half or a quarter or 1.7. We could have anything. And we can figure that out. Excel will do that for us. But we need to find this value. It's called a z-value again in statistics. And the way we do that is we take this number, kind of think of it as our discount rate, 0.0274 divided by our scaled volatility. And that's going to give us minus 0.477, or roughly about minus 0.48. So here's 0, here's minus 1, pretty close to minus a half, so it's right in here. And we're saying how much area is up through there. Well, we know that 50% is all the way up to 0. We're coming up just to about minus a half. Well, it turns out to be 0.317, or about 32%. Now, here's the thing that catches people off guard. You might think that that's the probability, but we actually have to double it. So it's more like 63%. So think back when I asked you to figure out what does your gut tell you. Most people are going to say 50%, usually at the highest. A lot of people guess less than that. It's a whole lot higher than 50%. Also keep in mind, we haven't allowed for time to drop or for volatility to fall. Now, what would happen if we increased volatility? What if you're trading a more volatile option? Let's make that 40%. Look at that. See, the probabilities start really getting pushed a lot higher. Now, of course, at 40%, we would have a different option price and we would have a different barrier. But the point is that with higher volatility stocks, the probabilities get pushed higher. So let's come back here to 0.20. So we're looking at about a 63% chance. Now, if we want to maybe do some guesswork and say, all right, we're allowing for time to move, possibly volatility, we probably don't need the stock to fall all the way to 97.3 before our option is worth 50% of its initial value. So maybe 98 will cause that same option price. Now you're talking about closer to a 73% chance that you're going to get stopped out. So this is why you have to be careful using these arbitrary lines in the sand, as I like to call them. You're going to get stopped out a lot. Yes, you're salvaging 50%. That's assuming you didn't blast through a stop order. But you're salvaging some money, but you're also not allowing for the stock to reverse, which, as you'll soon see, is also part of the problem. It's part of the reason that we have to double this probability. So let's go over to the presentation and see why we have to actually multiply this probability by 2. Okay, so back into the presentation. So we just found that the z-value, right where this red line meets the blue, right there was about -0.5. And again, you can see it's basically halfway between 0 and -1. So what Excel did is it calculated the area from all the way out here at the far left all the way up to, let's call it -0.5. And that's where it was coming up with that roughly that 36% figure that we had to double. So again, this catches traders off guard. They're saying, well, wait a minute, the barrier is that the stock price falls. So it sounds like what's called a one-tailed problem. We're just worried about the area to the left, that the stock price falls. But we actually have to double it because we have to consider the symmetrical other side. Now, why is that? Why do we have to double this probability? So let's look at a simulation here, let's say over 150 days, and this is a particular stock path. So notice that we touched 98, let's say if 98 is our barrier, right about here. So in this case, we actually closed below 98, if that's our expiration down here, but this is not the only probability that matters. Why? Well, let's consider two different stock paths. Let's call them path 1 and path 2. If this is path number 1, this blue and red, there has to be a corresponding one that will have the identical probability. Remember, there's tons of different possibilities in here. We have to account for them all. So what we're going to do is, it's called the reflection principle. We're going to look at our barrier as if it's a mirror, and we're just going to reflect this back to the other side. So if you look at this, if we were to turn this graph sideways, kind of looks like our bell curve right here. It's an exact mirror image. But notice this time, the red closed above the barrier. But that doesn't matter. The problem wasn't about the option expiring in the money or out of the money. The probability is, did it ever touch 98? So right there, we could have had an instance where stock path number 1 in blue did this, in which case it touched 98. But we could also have, with an equal probability, stock path number 2 where we get the blue plus the red. And they are identical probabilities. Obviously, they're identical through here. It's the identical path, but these are symmetrical. So they are the identical probabilities, and we have to count them because we're looking at the probability of touch. So again, you have to be really careful about using your stops thinking they're going to save you. There's a super high chance you will get stopped out. And this also compounds the problem. Traders start taking lots of losses and they say, gosh, I got stopped out on the last 10 trades. Now I'm up 30%. Let me get out while I have some kind of a gain. So they end up having lots of positions that get stopped out. And when they do have some winners, they're taking very small gains. And that is absolutely a long-term mathematical losing deal. So hopefully this gives you some added insights about using stops. Now I have a feeling some other people are going to give this a thumbs down because there are people that are just adamant about using stops. They've been trained relentlessly from lots of people that you have to use your stops. And I don't mind that. That's all part of a good discussion, but post it on Facebook and say why. Don't just put a thumbs down and run. We want to hear why you think using stops is a good idea. But for those who might be on the fence and ever wondered about it, hopefully you can see that there's another side to the story that most people are not telling you. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.